Welcome back to Talk Tickers. We are here to do exactly one thing: strip down the earnings calls that move the market so you don't have to suffer through 45 minutes of hold music and safe harbor statements. We are getting right into the thick of it today because the screen is red.
It is a very busy morning, and honestly, a confusing one if you just glance at the headlines.
It's extremely confusing. Today we're breaking down Brown & Brown, ticker symbol BRO. The insurance brokerage giant just released their Q4 and full year 2025 results. Now, usually, insurance brokers are the boring, steady eddies of your portfolio. You buy them, you hold them, you sleep well. But today, not so much.
No, definitely not boring today. We have to address the elephant in the room immediately. The stock took a serious beating. We saw it indicated down about 8% in the pre-market. It's been trading down roughly 6% during the live session.
Which, for a company like Brown & Brown, is a massive move. I mean, this isn't some volatile crypto stock. So the mission for this deep dive is simple. Why the sell-off? Because on the surface, this company looks like an absolute beast. They are buying revenue left and right. But the market is suddenly terrified that the engine under the hood, the actual organic growth, is stalling out.
It's the classic buying growth versus growing growth debate. And to add a little spice to the mix, we have a corporate raid on their talent that got very specific and very heated mentions on the call.
Oh, we are definitely getting into the talent war. That was the spiciest part of the Q&A. But let's start with the headline numbers because this is where the confusion starts. From a distance, this looks like a blowout quarter. Revenue is up nearly 36% to $1.6 billion. Earnings per share beat expectations. I mean, on paper, they're making more money than ever. So why is Wall Street dumping the stock?
Because Wall Street is looking at how they made that money. In the insurance game, you have two ways to grow. You can buy other companies. That's, inorganic growth. Or you can sell more insurance to new and existing clients. That's organic growth.
Okay, let's use an analogy here. It's the difference between planting a tree and waiting for it to bear fruit versus just buying the neighbor's orchard.
That is the perfect way to look at it. Brown & Brown is fantastic at buying orchards. That 36% revenue jump, that is almost entirely from their massive acquisition of a company called Accession. But when you strip away the new purchases and look at the core business, the trees they already planted actually shrank.
So the core business went backward.
It went negative. Organic revenue declined 2.8%.
Ouch. And for a growth stock in this sector, that is a massive red flag.
It is. Specifically, their specialty distribution arm, which is usually a profit engine for them, dropped almost 8%. That's a cliff dive for a division that is supposed to be steady.
That seems drastic. Is the business drying up? Is the economy collapsing? Or is this just a weird quarter?
Management argues it's a perfect storm of no storms. They blame three specific things, but if you want to understand insurance, you have to understand the third one, the tweener effect.
I saw that in the notes. Tweeners.
Okay.
Are we talking about teenagers?
Not quite, though they can be just as difficult to manage. Think of the insurance market like a nightclub. You have the main floor, that's the admitted or standard market. It's safe, predictable. Think carriers like Travelers or Hartford. Then you have the VIP section for the high-risk stuff.
The section with the velvet rope.
Right. That's the excess and surplus, or E&S market. Brown & Brown makes a lot of its money in that VIP section. Now, tweeners are the accounts that aren't quite dangerous enough to be permanently in the VIP section, but too risky for the main floor during bad times.
Okay, I follow.
When the market gets scary-like after a bad hurricane season, the standard insurers get spooked. They kick those tweener accounts into the VIP section. Brown loves that because premiums and commissions are higher there. But in Q4 of 2025, the standard insurers got hungry.
They wanted their customers back.
Exactly. The weather was mild, losses were low, so the standard carriers opened the doors to the main floor. They took those tweener accounts back out of the E&S market. Brown & Brown lost that volume because it moved away from their wholesale division.
So because the sun was shining and there were no hurricanes, the nightclub got rearranged and Brown & Brown lost their best customers.
That is effectively what happened. Combined with the fact that property rates in that VIP section crashed down 15% to 30% because there were no storms to scare up the prices.
So no storms means rates go down because capacity floods back into the market and Brown & Brown makes less money. It's the double-edged sword of a quiet hurricane season.
Precisely. And just to pile on, they had a tough comparison from the previous year. In Q4 2024, they made $28 million just processing flood claims. Since there were no floods this year, That $28 million just vanished.
Okay, so that explains the specialty disaster, but we can't let them off the hook entirely. Their retail segment, the standard stuff, was only up 1.1%. That's barely a pulse. What was the excuse there?
It's a bit messier. Management blamed multi-year policies written back in Q4 24. Essentially, they wrote 3-year deals back then to lock in pricing, so they didn't get to renew them this year. That creates sort of an air pocket in the revenue. Plus, they mentioned some delayed project work. They claim all this cost them 100 to 150 basis points of growth.
It feels a little like the dog ate my homework, but I suppose the math checks out. So organic growth is stalling, and competitors are poaching customers. If I'm an investor, I'm looking for a silver lining. Did the big check they wrote for Accession, that massive acquisition, actually help?
It bought them revenue, certainly about $405 million of it this quarter alone. To give you context, that is a huge chunk of their total growth. But it missed guidance slightly. They were guiding for $430 to $450 million.
So even the acquisition came in a little light.
A little. But the real story is the margin dynamic. Accession is currently a lower margin business than legacy Brown & Brown. It dragged the company down by about 200 basis points in the short term.
Wait, let me get this straight. They bought a company that lowers their average margin, but I see here they actually raise their long-term margin targets. That math doesn't add up immediately.
It is bold, isn't it? They used to target 30-35% margins. Now they're telling Wall Street to expect 32-37%.
37% margins. That is software company territory, not insurance brokerage. How do they plan to pull that off if the new asset is dragging them down?
Synergies. CFO Andy Watts is betting the house on integration. They think they can strip out about $30 to $40 million in cost by next year. The pitch is basically, ignore the mess today. By 2028, we will have digested this acquisition, fired the redundant back office staff, merged the systems, and turned it into a cash machine.
So the narrative from management is, ignore the messy organic growth right now. Look at the margin machine we are building for 2028.
That is the trade. They are playing the long game. The market, however, is playing the what have you done for me lately game, and lately the organic growth is negative.
Which brings us to the drama. We have to talk about the talent war. Usually earnings calls are dry, but CEO Powell Brown sounded genuinely angry during the Q&A. He started talking about injunctions and piracy.
He didn't hold back. He was addressing a specific competitor, widely believed to be a startup called Howden, that aggressively raided their staff.
Raided is a strong word. What are the damages here?
Powell Brown confirmed that 275 teammates left for this competitor.
275. That's not a raid. That's an evacuation.
It sounds huge. And he noted that about $23 million in known annual revenue walked out the door with them.
Okay, play devil's advocate here. Brown & Brown does billions in revenue. Is $23 million really worth getting litigious over? It feels like a rounding error.
Financially. You're right, it's a drop in the bucket. But this isn't about the money, it's about the contagion. Insurance is a relationship business. The revenue doesn't belong to the logo on the building, it belongs to the broker shaking hands. If those brokers leave, the clients leave.
So if Powell Brown doesn't stop this now, he's worried the other 14,000 employees might get ideas.
That is the fear. It challenges their cheetah culture. Brown & Brown is known for being high commission, eat what you kill. If a competitor shows up waving big guaranteed salary checks, it kind of breaks their model. That's why he mentioned they have already obtained an injunction and are enforcing non-solicitation agreements. He basically said, we will see you in court.
It's a distraction. Management claims they are rehiring, but you have to wonder if this is going to keep popping up in Q1 and Q2.
It certainly raises the risk profile. Investors hate lawsuits, and they hate losing talent.
Let's zoom out a bit. We've got the organic growth miss, the margin play, and the talent war. What is the broader investor context here? What did they say about the macro environment?
They described a two-speed market. On one side, you have casualty insurance. Rates there are still grinding higher up, 3 to 6% for primary, and even more for excess layers.
Because of the nuclear verdicts we keep hearing about.
Exactly. Juries are handing out massive awards, legal costs are up, so insurers have to charge more. That's a tailwind for brokers. But on the other side, you have property, and that elevator's going down fast.
Because the wind didn't blow.
Right. Management noted that because hurricane losses were low in 2025, capital's flooding back into the reinsurance market. Supply goes up, price goes down, especially in E&S.
There was a great question in the Q&A about the elevator versus escalator theory. Can you explain that?
Yeah, it's the idea that insurance rates go up on an escalator, slowly, step by step. But when they correct, they take the elevator down. We are seeing the elevator effect in property right now.
So is the hard market, the easy growth era, over?
Management argues we are just returning to normal historical growth. They don't see a recession. They see the economy as stable and customers as cautiously optimistic. They are essentially telling investors, stop expecting the sugar high of the last 3 years. This is what normal looks like.
Normal is boring, though, and investors hate boring when they paid a premium multiple. What's the outlook for 2026? What should we expect in Q1?
They were pretty honest about Q1, and it's not great. For specialty distribution, expect it to remain flat. They are still fighting that flood comp from the previous year, and the rate drops. They think growth should pick up in the second half.
And retail?
Expecting modest improvement over the 2.8% full-year organic growth of 2025. Not a rocket ship, just modest improvement.
And they threw out some other numbers, tax rate 24-25%, and interest income is going to be a headwind because rates are lower and they spent their cash on the Accession deal.
Which means the easy money from sitting on cash is gone too.
So we have a transition year, a messy Q4, a flat Q1 likely, and a promise of a better second half.
That is the setup.
All right, that brings us to my favorite part of the show. We've looked at the past, we've looked at the guidance. Now let's look at the opportunity. This is not financial advice. Disclaimer, we are just two voices in your headphones. Do not trade based on what we say. This is for entertainment purposes only.
Please don't bankrupt yourself.
Okay, here is the pitch. I'm calling this the hurricane call option, or maybe the buy the bleed trade.
I'm listening. What's the angle?
The stock is crashing because the weather was too nice in 2025. No storms means insurance rates go down, and Brown makes less money.
Right. The elevator's going down.
Exactly. And management just told us Q1 2026 is going to be flat. The market hates flat. I think the stock flushes down into the $60 over the next few months as people panic over the end of growth.
That is a very distinct possibility. That $60 range would be a significant pullback.
That is the buy zone. You go long BRO, specifically targeting Q3 and Q4 of 2026.
Why Q3 and Q4?
Because weather is cyclical. The moment a named storm spins up in the Gulf in 2026, two things happen. Panic sets in and insurance rates harden immediately. The elevator goes back up.
But wait, if a storm hits, they lose their contingent commissions. Andy Watts noted those were over $250 million and highly profitable because of underwriting profitability. If the wind blows, they lose that profit.
That's the twist. The market thinks about the lost profit, but the trade is actually betting on the reaction to rates hardening. The moment rates turn hard, the forward-looking growth estimates go up. You lose a one-time contingent cash, but your multiple expands because organic growth returns.
So you are trading the multiple expansion, not the earnings. You are buying the dip on the Q1 earnings miss, which is almost guaranteed to be meh. And you are holding for the inevitable market panic when the wind starts blowing again.
Precisely. It's a buy the bleed strategy. You bet that Wall Street is too short-sighted to see the clouds forming on the horizon. Plus, by the second half of 2026, those Accession synergies start kicking in.
It's risky. You are fighting the tape. But if you believe in the return to normal, buying Brown & Brown in the $60 has historically been a very good idea. And if the property market hardens, those organic growth numbers will flip positive very quickly.
All right, let's wrap this up. Brown & Brown is a massive cash-generating machine that just hit a speed bump called organic growth.
That's the summary. The market is punishing them for buying revenue rather than growing it, and for the temporary headache of property rates cooling off. The talent war makes for great headlines, but it's likely noise in the long run.
The real signal to watch is that margin expansion target. 37% is huge.
If they hit that, the stock is cheap. If they miss that, and organic growth stays negative, then we have a problem.
Management is betting the house on integration and margins. The market is betting against their ability to keep customers without buying them. Who wins in 2026? We'll find out.
We certainly will.
Thanks for listening to Talk Tickers. Don't let the pre-market ruin your breakfast. We'll see you at the next earnings call.